China, China, China. That has been all the talk on financial media over the past week or so, as we have seen some pretty major predictions from most financial experts here in the West dictating a collapse in the Chinese economy. And although on the surface it looks like that there is a big real estate crisis taking place and a potential collapse and decline in the ever-growing Chinese economy, in this video, I want to share with you guys a reality check to understand why the situation in China is not as bad as many people are predicting it to be here in the West. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So the first thing I want to address is why exactly are we discussing China in the media so much recently? Well, if you haven't heard, China is going through this little property crisis and obviously a lot of tensions with Taiwan, where all of a sudden a lot of mortgage lenders are not paying back their mortgages on some of the properties that are unfinished in China. You see, a lot of the developers, the real estate developers in China, built a lot of properties, leading to a big supply shock and leading to many people not being able to pay their payments, as these developers leveraged all their cash to build these properties. And because of that, we're starting to see a decline in the growth outlook for China, as obviously real estate is over 30% of the GDP in China. But we can't just look at this data on the surface. We need to actually understand and do a little bit of a deep dive to understand why this is the case and how this will actually affect the US or Chinese stocks. You guys know that personally I do own two major Chinese stocks, first being the Xpeng Motors EV company, which is by far one of the most innovative electric vehicle companies in the entire country right now. And then obviously I own Alibaba, which is the biggest e-commerce giant across the world, which obviously has gotten absolutely destroyed over the past 2 years. And some people might still call me crazy for being bullish on China, but I do think I have a lot of strong arguments in the favor of the people, especially because right now the sentiment is simply way too bad. I mean, even after this massive decline in the Chinese stock market and obviously the Evergrande default crisis that happened in 2021, some people still think there's an impending collapse yet to come in China. Well, have many people thought of the situation where this crisis has already happened and that the Western media is only now catching on to this crisis happening about 6 months later? I don't think many people have been addressing that situation. Because as you can see, the property market in China actually stayed very hot throughout 2018 and 2019. And it's actually been on a decline since the middle of 2019, well before the pandemic started. So all we're seeing right now is a sudden decline in the demand for properties, as we are starting to see an oversupply of properties for the companies and the property developers that wanted to take advantage of this massive interest in property development within China. And since China is the second largest GDP in the world and is one of the fastest growing GDPs across all the big top 10 countries in the world, it's pretty normal to expect an overly hot real estate market when the middle class in China is growing at such a rapid rate. As you can see, a lot of the data that came out in 2021 showed us that America's middle class is starting to look very similar to China's middle class. And although in the short term that is a bad thing, in the long term that might be a good thing for the economy, because as we've clearly seen, America's GDP is extremely stable, and some of the standards of living we're seeing here and the GDP per capita is significantly better than other countries. And I think that is something many people are simply not factoring in right now, because obviously China is one of the most hated countries from most Americans in the West. And I think that is precisely why we are seeing so much fear and FUD in the media right now around China, especially on YouTube. And to be honest, for me at least, there's a couple of reasons why I think this little property bust is nowhere near the same as what happened in 2008 here in the US. A couple of reasons being the fact that a lot of the banks in China are actually owned by the state, meaning it's very easy for China's government to inject liquidity into them to be able to fuel their growth. And another reason being the fact that China's household income to household value index is over 40x what we here have in the US. Essentially what that means is that if you make $50,000 a year in China, you can be approved for a loan of almost $2 million, whereas in the US, you would be capped to around 250K to 300K. And as you can see right now, that is one of the highest rates because obviously China is one of the most populous countries in the entire world, and real estate is growing at a massive rate in that country because of obviously the geographical restrictions and whatnot that they have. And so that's a pretty big reason for why the real estate market has been so hot and why there is so much leverage involved in the Chinese market, which has been the case for the past 40 years that China has been growing at such a fast rate. But obviously the media is only catching up to this right now. And if you pair that with the fact that China's savings rate at 44.9% is one of the highest in the entire world, it really goes to show that even if there is a global collapse because of China, China's economy at least has a good chance of surviving it because of the fact that there's significantly more discipline from consumers within China. And that's not even accounting for the fact that China's household balance sheet is also one of the best across the entire world, which means that people have more assets than they have liabilities. And so overall, at least for me, even though yes, there's a lot of concerns here in the short term, I think there is a good chance China's economy will recover very well out of this, especially because right now the forecasts for 2022 growth are at 3%, when the US's GDP is actually expected to decline in 2022 and in 2023. And obviously a big reason for that is because China is actually cutting interest rates instead of hiking interest rates. That is obviously stimulative, and we all know what tends to happen when a country tends to cut interest rates, which obviously sends asset prices to the moon. And that's a big reason for why I continue to be a buyer of some of my favorite Chinese stocks, being Xpeng Motors and Alibaba. And although for sure we have no idea whether this interest rate cut is going to actually have an effect on saving the mortgage business of China at least, I do think it's going to have a pretty big effect on the consumer end business of China GDP, which is obviously the area that I'm investing in. I'm investing in the internet area, the electric vehicle area, and an area where there's a lot more R&D conducted than obviously the real estate business, which tends to be very stable. And so yes, even though I'm not an expert on the mortgage business, I can take advantage of this interest rate cut and invest in the tech area of China at least, which will most definitely benefit from this interest rate cut as more and more people have more money to spend on new innovations. And if I'll be completely honest, a lot of Chinese stocks are already showing patterns of having bottomed, even though yes, over the past month or so, they have collapsed a little bit more. As you can see, the weekly time frame on Xpeng Motors, for example, the peak capitulation that we witnessed happened in March. Then we had this nice rally all the way up to the end of June, and then now we're seeing this low volume sell-off on fear and FUD around the Chinese economy, even though this company specifically has been beating all analyst estimates and they've been throwing their growth rates out of the park. And overall, this is kind of what the bottom of a market actually looks like. We tend to make this higher low, we tend to rally, and then we get this final pullback to retest those same lows before we continue higher. Now, obviously, we have yet to see what happens, and I could be completely wrong because there's nothing guaranteed in the stock market. But as usual, as investors, we try to take advantage of the risk to reward that we're seeing instead of just being fearful and not pulling the trigger. But as usual, guys, make sure to drop me a thumbs up, and I'll catch you guys in the next video.